Hi everyone, welcome to today's video. So recently in the US, there is another bank called as First Republic Banks. It is staring at the verge of collapse. Now almost every Friday, there is a new bank that faces the challenge of collapsing and the government tries its level best to save it, but it unfortunately collapses. I'm here to tell you that despite all this negativity, we are in a bull run. Now you laugh at me, you will say that, what type of nonsense is this, that on one hand, the economy is collapsing, recession is there, Fed hasn't controlled inflation or interest rate, transpiring into banking crisis, and you are announcing that we are in a bull run. So I'm going to share data facts and I'm going to prove it to you that we are actually in a bull run. So let's keep a bet that if I'm able to prove it to you that we are in a bull run, then do press the like button. If not, then don't press it. So with that said, let me prove it to you that we are in a bull run. Number two, more importantly, how this bull run is going to transpire, because understanding this aspect is going to help you make money. And third and finally, what is it that big investors are doing? I am going to help you analyze their cash positions and their portfolio. So let's kickstart our video and let me first and foremost prove it to you that we are in a bull run. Okay, so there is no set definition of what a bull run means, but the typically accepted definition of bull run says that if the market, overall broad market, has fallen by more than 20% twice, and if it recovers beyond that by 20%, then it means that we are in a bull run. So that is the mathematical definition. I can't lie about it. So let me now prove it to you with data that we are actually in a bull run. So this is the first major fall that happened recently, and this is the COVID fall. And here the markets corrected by roughly 40%. Now the second fall, when did it happen? So if you aggregate the data from here, it will come out to be roughly 20%. So two times roughly 20% fall has happened. Now, has the market recovered by 20% since then? So the short answer is yes, that the market has recovered by more than 20% since falling by 20% twice. So technically, we are in a bull run. Now you'll say that, okay, what kind of nonsense bull run is this? My portfolio is still in red. Then how is it exactly bull run? Why am I not making money, etc., etc.? All those are very valid questions. And let me tell you the different types of bull runs that can exist in a market. See, the typical type of bull run that we are accustomed to seeing is somewhere here. So here what happens is that there is a very, very sharp fall and then there is a very sharp recovery. So all of us are very happy that, stock market gir gaya, then we bought stuff and now it has risen. So all good stuff has happened and I've made a lot of money. So this is a very fast bull run. Now the type of bull run that we are witnessing somewhere here, this is type of a very slow bull run. And my prediction is, and I will explain that to you in the last section, that going forward, it is actually going to be a fairly slow bull run. It is going to be a substantially sideways market. Please study this video very, very carefully. Make notes. This is going to protect your portfolio and will also help you make a lot of money. So far we have spoken about two types of bull runs. One would be this, where there is a very sharp recovery, and the second type of bull run is a very slow moving bull run. Now, just to complete the thought process, let me also very quickly draw out the entire chart as to how I envision this bull run panning out and draw out the chart for the next 2 to 3 years. See, this is a very likely scenario that we will move up, right? And we will again fall down. We will move up, then we will again fall down. We will move up, we might again fall down. Now, of course, this might not work to the T, but there is a very, very strong likelihood that, see, overall trend of the market will still be up, that this market is still going up. But there are points when the market corrects quite aggressively and then it recovers. So this is a slow moving bull run, and this is what I forecast is going to happen over the next few years. Now you might have a natural response. What is this like slow moving bull run? Why would this happen? Okay, the reason why this would happen is that there is a strong disconnect between the fundamentals of the economy and the way stock market is right now behaving. In fact, I will show you data where I will prove it to you that there is a breakdown of relationship between the equity market and the bond market also. We are living in highly weird times. So please study the next section very, very carefully. So in the next section, let me systematically explain it to you why we will be up in an uptrend over the next few years, why this blue line will be followed, right? So let me break it down for you that why generally we will stay upwards, but it will not be like hyper aggressive growth. See, there is a tug of war that is happening between two parties. One is called as debt management, and the second economic factor at play is the growth management. These two things are attacking each other. So let me explain both these points very, very quickly. Now, debt management in very simple term means that the debt all across the globe is going up. governments all across the world have taken a lot of debt. Now, whenever there is a lot of debt that has been taken in the economy, that debt needs to be repaid, right? And what decides at what rate that debt needs to be repaid? Well, that is decided by the interest rate. Now, the story so far is fairly clear. This is something that I've explained over and over again on several of my videos. So I will not belabor this point. So basically what happens is that this interest rate cycle, a new anchor is going to be found. Now, again, I will link one of my previous videos on this topic, that why do I feel that the interest rates or the typical interest rates which used to exist at 0%, why that anchor is going to move to 2 to 3%. So please watch that video. You will understand that more. But this is the first aspect of this tug of war that is happening, that debt management needs to take place, and for that the anchor interest rates in the economy is going to move to 2 to 3%. And this is the hypothesis with which I am designing my portfolio. Now, on the flip side, every government worries about growth, because if the economy is not growing, you have to fight elections, you have to fight a lot of things, and politicians need to preserve their seat and do a lot of advertisements. Now, if they have to run ad like, GDP growth is 0.5%, now will you be impressed? The answer is no. So they have to manage growth, right? So this is called as growth management. So basically, in very simple terms, what is going to happen is that the target interest rates will be 2 to 3% in the US, and I'm picking US as the anchor. You can contextualize it to India, but we are going to move in that range between 0 to 3%, right? Or maybe even 0 to 4%. So whenever we are above that 2% anchor, there will be growth in the world. And whenever we are below that 2% anchor, there will be degrowth in the world. Now, in this entire tug of war, because the economy will fundamentally grow at a slower pace, therefore, stock market will eventually grow at a slower pace also, but it will still rise up. So this is the overall fundamental viewpoint. Now, in this entire game, there will be something called as down cycle, and then there will be something called as the up cycle for the stock market. Now, down cycle simply means that, this is the time when the prices or the stock prices are falling. This becomes a great time to aggregate stocks. On the flip side, if you're buying stuff when the cycle is moving up, you are buying stuff slightly more expensive, and it will be difficult for you to make sustainable returns from the stock market. So this is going to be a highly complicated style of investing that you will need to follow now, because you will need to exhibit both growth style of investing and amalgamate it with value style of investing. So without confusing you, let me break it down in this simple sentence, that you should only be buying fundamentally good stuff when they are available for cheap. If things are not available for cheap, you will buy it and your portfolio will suffer like anything. This is already happening to some of the biggest growth investors in our country right now. Their portfolio over the last 2 years have been giving negative returns, and they are just cutting out their stocks and moving to new set of stocks, and they will still incur massive losses even this year. Why? Because they are not fundamentally getting this point. Please forget about the concept that अच्छा stock खरीद लेंगे, कभी ना कभी तो बढ़ ही जाएगा. No, please do not do that. Please understand that you need to buy good stuff, but also buy it at good price. Now, in case you are interested how to do that, how exactly to build your portfolio, what exactly is your style of investing, how exactly to identify it, I have prepared an entire course on stock market. You can easily sit, watch it lecture by lecture. We have created an entire community. You get community support also. I analyze the portfolio of some of these students also. In case you want to learn things in step-by-step manner, you could consider joining it. The link is in the description and comment box. Okay, so back to basics. You simply need to buy things when they are at a discount and avoid things when things are going up. In fact, this becomes a great time to sell stuff. Now, how do you identify that? Let me give you 3-4 trigger points here, and let me now show you some data and facts as to why now is a good time to do your investing and wrap it up, because now the markets have started to give a breakout. So first and foremost, you need to take a look at the macro trigger. That if you study the fall that has happened from 2021 onwards, what was the primary reason for the fall? Well, there were many, but if we have to consolidate 2 macro reasons, one was that the inflation in the world or the general price rise in the world was going up at a very aggressive pace. For example, if you study the data in the US, you will categorically see this chart that the inflation reached and made a new high of approximately 10%. Since then, it has started to come down. So the inflation is cooling off. It is reaching that 4 to 5% in the US. Second key macro trigger was the interest rate. And the latest study shows us that the interest rates are about to peak as well. In fact, it is estimated that the US Fed is going to cut the interest rates going forward very, very soon. RBI recently did a monetary policy committee review, and there they decided that they are not going to increase the interest rate. So interest rate hike has been halted in India. So to cut the long story short, inflation seems to be in control. It is coming coming down, and interest rate cycle as of now has been stopped. Please note the word that I'm using the word cycle. It does not mean that it has been permanently cut or it will not go back up. But at least for this round, there is a very clear indication what inflation and interest rate will look like all across the world, including in India. So from a macro point of view, it is a good time to invest. Now the second key trigger why the stock market is likely to go up like this from here, it is very, very simple, because there will be earnings improvement. Because think about it this way, that why do the stock markets go up from a short to mid-term perspective? Well, there is some kind of global positive news. Second, there is some kind of good company or industry specific news. कि यार earnings बढ़ गई, profits बढ़ गए, all this stuff only, no? So let's quickly check that what is the estimate on earnings going forward, at least for the next 3 to 6 months. So here is the aggregate data at the market level, and this is for S&P 500 companies, this is Nifty total market, this is for Nifty 500, and other set of categorizations have been done. And what you will notice is that almost every segment, the earnings have gone up. You will see negative here, but they do not have the previous data here, so please ignore this. So you will see that the earnings have been up in the last quarter if you compare it, the March quarter with the December 2022 quarter. So we are already in an upswing. Now what about pre-December? That can we check the earnings report of different companies? Okay, so pick any company that you like, or pick any big company in India that you like. So let's pick Reliance, right? And let me show you some trends, and this is the trend analysis that you can do on your own. So what you will notice is that, you know what, if you take a look at sales, you will see that the sales were going up and up, and then there was a sudden dip here in 2021. Then it started to go up again, and now it is sitting on highest ever sales. Now, do I mean that you should go and buy Reliance? No, that is not a recommendation. You need to do more fundamental analysis. I am simply trying to tell you about the sales number. That's it. So please take this part of the conversation only from this segment of this video. So what about other companies? So let me show you the example of Maruti, right? And this is a lagger stock. So here you can see that the sales were going up, right, up until 2019. Then 2020 dip here, 2021 dip here, then it started to go up. So you will always find, even for big companies, two things in the Indian market. One is that the sales were going up, then it dipped, and then it went up like this. So this is the trend that Maruti Reliance is showing. If you check some other companies, so go and check Bajaj Finance. What you will see is that there was never a dip in their sales to begin with. So it just kept on going up like this. Yes, the growth rate slowed down, but in terms of the sales figure, it never came down. So in India, we have two types of good companies. Please note the word good companies. That one, there was a dip in sales and then it came back up, or the sales figure never decelerated, so to say, it just slowed down in terms of the growth rate. So both these type of companies are going up, and starting next quarter or probably another 2 quarters, these strong results will be posted, and that will act as a trigger sign for the stocks to go up. Now let me show you one more indicator as to how the stock market will go up, and this you can understand by doing the IPO analysis. Now in IPO, there is something called as dry powder. So let me quickly explain what the meaning of dry powder is. But before that, let me show you a quick statistic. So this is the amount of dry powder, and you will see that this is on an ascending trajectory. Ascending trajectory means ki बढ़ती हुई trajectory. In 2021, PE firms were sitting on $3.2 trillion. Now they are sitting at $3.7 trillion. Now what is the meaning of dry powder? It's very simple. Basically what happens is, when you read about these big companies like Sequoia Capital and वगैरह VCs, what do? They basically have a lot of money which they pour into startups like, let's say, Paytm, right? But how do these VCs get money? And basically they get their money from private equity companies or sovereign wealth funds, right? So all these different government organizations also give VC companies money. So in short, VC companies first raise money and then they deploy that money, right? So dry powder simply means that VC firms have been able to raise money, but they have not deployed it. So what do you imagine is going to happen, that if the VC funds and PE funds are sitting on so much dry powder? Well, they are going to deploy this money. Where are they going to deploy this money? In startups. When are they going to deploy this money in startups? When they think that everything is hunky-dory, they will start deploying this money, which is a sign that the overall investment ecosystem is replete with cash and the overall investment sentiments are bullish. So this brings us to the third section, because I can show you all the data, facts, charts, but unless the big investors are acting on it and they have money, it would be very unlikely that the stock market will go up. So big investors actually need to believe in the stock market. They need to be bullish and they need to be putting money already in the stock market. So let me take you through 2-3 portfolios and let me show you what exactly is happening. So first, let me help you quickly analyze Mr. Warren Buffett's portfolio. And what you will notice is that this is his position on equities up until the year 2022. So you will see that in 2020 or by 2020, he had decreased a lot of his position. And we are talking about billions of dollars, right? So this is a lot of money. Then he steadily increased his position up until December of 2021, right? And since December of 2021, what has happened? Actually, the stock market shrank, right? Because there was a crash in the stock market. So it's not as if that he has withdrawn his money from the stock market. It's just that let's imagine that here he had like $100 billion in the equity market. Now stock market unfortunately has fallen even now by let's say 15%. So he's sitting on $85 billion. So he has not pulled out his investments. He had been maxed out, so to say, by December of 2021. And since then he has maintained his position and he has been adding 1 or 2 stocks here and there. Now this can also be studied from this particular graphic, that if you study the fixed deposit positions that Mr. Warren Buffett had, he has constantly brought that down. If you study his cash positions, it was the highest up until 2020 mid, and since that he has brought that down and has rather deployed that money in equities. So he is mostly equity right now with some opportunistic cash lying around. So this acts as a very important inference point for smart investor to realize the fact that, you know what, going forward it's not a perfectly bullish market, but yes, it is a market that is likely to grow. It will be a slow growth bullish market. It makes sense to invest your money in equities, but at the same time, keep some cash positions so that you can take some opportunistic bets. Now, just to re-emphasize this point, let us take a look at the quarter-on-quarter turnover of Mr. Warren Buffett's portfolio, and you will see this as the standout figure. And when did he add most of his position? By March of 2022. So between the time period 2021 end and 2022 first quarter, he had built majority of his positions. Now let me show you one more portfolio, and this is again of a billionaire legendary investor called as Bill Ackman. And you will again see somewhat of a similar trends that by 2020, Bill Ackman was somewhere here, then he increased his position. The equity overall market fell. He has added more positions. So he has been also constantly buying. So it's not as if that he's not buying. He's again buying, pouring in money. So he also looks to be optimistic about the stock market. But his buying has been more spread. And again, by taking a look at quarter on quarter turnover, you can see these large spikes here, here and here. And you will see that he has been buying almost every six months. He has been building huge positions. But he's a net buyer in the economy right now and he is building his positions. The likely hypothesis here is that after 2021 or between 2021 and 2022, stock market has corrected quite a lot and he has been able to build his position in that zone also. Okay, so now let me show you third and final portfolio of India's investor, and this is Mr. Vijay Kedia. And what you will notice is that he is generally a very aggressive investor, and the trend is that he has built more of his position in this zone. Right after 2020 he was here and here and here. So you can clearly see that he has added stocks almost like an interval of six months, and he has built huge positions now and sitting on his highest ever positions here. Now, can the stock market correct from this point? Of course, and his portfolio might be here, but give it like 2 to 3 year window, it is very, very likely that he will go back here somewhere. So therefore, it would not be incorrect to surmise that even he is bullish on the stock markets right now. So now comes the last segment, which no one is talking about, because I just used the word that we are in a bull run. Now, with that logic, you should sell your house, sell everything, put all your money in the equity market and be done. Wait for 5-6 years or whatever it is. Well, that type of strategy had worked wonderfully well up until now, but now it makes more sense to be thoughtful. Why is that the case? For that, let me take you to this chart. And this is called as equity risk premium chart. Now, in simple terms, equity risk premium means that how much risk you are taking by investing money in equities, right? So, I mean, why you should be considering equities? Because by going to this blue chart, this is the debt chart, right? So here, let me give you an example. That let's say that right now I give you 100 rupees and say that will you invest in equities or will you invest in bonds or do a fixed deposit in HDFC Bank? You'll say I'll do a fixed deposit in HDFC Bank because I'm anyways getting 7.5%. Here returns are not coming because the equity risk premium here is low. So in simple words, equity risk premium means that what is the added premium or reward that you are getting by picking a riskier instrument called as equity. For example, here, if you consider this particular graphic, this is the year 2010. Here, everyone was scared that, you know what, stock market has corrected quite aggressively in 2008, 2009. So it will continue to fall. So in order for you to risk your money in the equity market, what is it that needs to happen? Well, the ERP or equity risk premium needs to be high. So you would probably go and consider this. So when equity risk premium is high, you have more incentive to go and invest your money. Now what is happening is that the equity risk premium has gone sideways. It has gone very, very low. On top of that, what has happened is that if you consider this blue graphic, this is for debt. Here, the long-term debt has completely gone bonkers. Now, what is the meaning of that? Well, again, I started the story by talking about banks, that almost every weekend there is a new bank that is collapsing. Why is that happening? Consider the scenario of Credit Suisse. Consider the scenario of Silicon Valley Bank. All these banks are going under simply because of the fact that long-term debt in the US debt market, that is decaying. So that itself is a very lengthy and complicated topic. So I'll probably pick it up some other time. But to cut the long story short, what you will notice is that there is always a type of an inverse relationship between this blue graph and orange graph. But now what has happened is that the equity market and the bond market has completely unhinged. There is no relationship between the two. That is what it looks like by looking at the graphs. So to cut the long story short, what is happening is that both the equity market is weak and debt market is weak. Such a scenario has rarely ever played out in the economy. And therefore, it is very, very hard for anyone to guess when the stock market will completely recover, at what pace will it recover, when will it fall, when will it not fall. You have to be prepared for deeply uncertain times ahead because the economy is fundamentally weaker, but the stock market has to be kept alive even artificially, and that is what the governments are currently doing. You can sit out on the sidelines, wait for the stock markets to completely recover and then put your money, but the wait could last even for a decade, and during that time you will miss out on a lot of investment opportunity and your wealth will be eroded due to inflation. So here are my top 3 tips. Number 1, please invest. Please do not sit on the sidelines. I keep on saying all the time. Second key thing, you need to invest intelligently. You need to learn about stock investing. So if you get a chance, do learn from my videos. Again, I run a course. If you are interested in learning things systematically, you can definitely consider joining it. Third and finally, please understand the type of market we are. Right now, it's a buyer's market. It makes sense to develop and cultivate your portfolio. It is not a seller's market. When the seller's market comes, please do not say that, hey, it is a buy and forget type of a market. Start selling out stuff. I do make all the announcements and share all the portfolio updates and organize special classes for my students. So do consider checking the description and comment box. I hope you enjoyed this video. If you did, do press the like button and I'll see you soon.